If you go back to the period from 2012 to 2019 in New Zealand, inflation was too low. We were all surprised by it averaging only 1.2% a year over that period of time. So we've gone from this unusually low inflation period, 2012 to 2019, and then worries about that, especially 2020, and now we're into this high inflation period. Who's to say we don't, when things settle down in 18 months' time, go right back to where we were in 2012 to 2019 with very low inflation?
Welcome back to Tea with Tony. Let's start with the big picture. Recession. Will we or won't we? In the past month, we've seen another cash rate increase with more to come. What does that mean for interest rates? And house prices are continuing to fall. But are they entering the endgame stage? Let's get Tony's perspective. Hey Tony, how are you?
Good, thanks Lenska. Good to be online again.
Yeah, nice to see you. A little bit of a longer gap this time, but I'm sure you've got lots to share. So there's a lot of mixed views on this recession thing, and so are we heading into recession? And if so, what does that mean in tangible terms for everyday Kiwis? Let's keep it real.
Yeah, well, that's the thing. In tangible terms, a recession usually means the unemployment rate jumps up sharply, like the 3% increase over 2008, 2009, and similar increases in the past. And so in our head, that's what we think is going to happen. High unemployment, people slashing their spending, mortgagee sales, all these sort of things, and everything being quite ugly out there. But people have to recognise that there are massively key differences this time around compared with in the past. And the big one, of course, is a shortage of employees, of staff in New Zealand, Australia, the UK, Europe, United States, etc. So first of all, businesses are not going into this period of challenge with excess staff numbers. They still want to hire extra people. We've got about a net 3 or 4% of people, businesses in the ANZ's Business Outlook survey saying they want to hire more staff, even while at the same time we've got almost a net 50% of businesses having a bad outlook for the economy. So that disconnect is vitally important. It means that, retail spending, it is going to weaken a lot because, cost of living factors, etc. But it's not going to spiral downward. The labour market isn't going to spiral downward. So from my point of view, my message is I fail to get excited about the recessionary talk, because even if our economy was sort of to shrink by half or 1%, it really wouldn't have the same negative impact on household finances, small business performance, as has been the case in the past. My advice to people would be forget about following all the recession talk and concentrate more on your existing issues of trying to get your staff, managing short-term finance, that sort of thing.
So just staying on the recession for a minute, because I know people like to, as you say, talk themselves into it and get into this kind of freaky, it's all doomsday. But there is quite global talk of, the Fed and of the US, China, big recessions, and how, if those big markets go into recession, how will that affect us?
Okay, yeah, first thing, if there is recession overseas, and there is a strong possibility of that, when we look at the monetary policy tightening in the United States, the zero COVID strategy still being followed in China, the energy price crisis in Europe and in the UK, we definitely can't rule out a global recession. And then we've got to think, now, how does that usually impact New Zealand? Why does that matter? And there's two key ways in which it matters, maybe three if we include some share market weakness. The first one, of course, is if people are losing jobs overseas, they're not going to go on holiday down in New Zealand. Well, no, exactly the opposite is going to happen. We've opened up the borders, so even if the world does go into a deep recession, we're still going to have more people visiting New Zealand in a year's time than we have at the moment. So the net foreign visitor flow is still going to improve regardless of what is happening with those overseas economies. So that's the first thing. Secondly, and the other way in which this tends to affect New Zealand quite badly, is people cut back overseas on buying a lot of our products, our food products, fibre products, etc., sent overseas, and so you tend to get a fall in the prices of these things. Well, of course, another aspect of what's happening overseas related to Russia's war in Ukraine and half the grain crops not going to be planted, the soaring cost of the fertiliser and feedlots for cattle, etc., along with floods or global warming outbreaks with crops sort of wilting in the field, food prices are high. We are a food exporter. we have been exporting food in one form or another for a great period of time. And so that means that even with weakening world growth, because of these unfortunate climatic events, etc., overseas, there's still very strong support for New Zealand's primary sector. Vulnerabilities on logs going to China because of a fall in China construction, most definitely. But overall, if we were looking at a normal sort of world environment and I was looking at this downturn in world activity, I would be sounding a heck of a lot more worried at the moment than I really am with regard to those export prices. So negative for New Zealand for sure, but again, there are some key differences here from downturns in the past.
Look, I want to move on to interest rates and inflation. We talk about this every month, but it does seem a little all over the place at the moment, and I'd like you to add some sanity to the discussion, is the truth, as you always do. So, as forecast, the OCR is marching onwards and upwards. No surprises there. But what does that mean for interest rates that everyday Kiwis pay?
Okay. Key thing to note about all of this is that we have seen central banks doing something relatively easy in the past few months, increasing interest rates rapidly, delivering extremely strong warnings about inflation. And it's easy in that they had interest rates too aggressively low in 2020 and 2021 in particular. So it's sort of been an easy job for them, jack the interest rates up because we've got to get away from these really stimulatory levels. Now, in the next couple of months, we enter the far more difficult stage of, well, we've already increased our interest rates a lot. How much more do we need to keep going? Don't know. That is the simple answer for every economy around the world at the moment. We don't know how much sort of restraint above average needs to be applied to the interest rates, because most of what's been happening is getting interest rates up from really below average levels. So the confusion, the uncertainty, the debate about monetary policy we're seeing at the moment, it is going to continue for quite a few more months before we get a better feel for actually what is happening with underlying inflation. And nobody should be under any illusion here about the ability of anyone on the planet to accurately forecast inflation. We simply can't do it in this day and age. We're all talking now about high inflation and we're forecasting high inflation, especially overseas. But if you go back to the period from 2012 to 2019 in New Zealand, inflation was too low. We were all surprised by it averaging only 1.2% a year over that period of time. So we've gone from this unusually low inflation period, 2012 to 2019, and then worries about that, especially 2020, and now we're into this high inflation period. Who's to say we don't, when things settle down in 18 months' time, go right back to where we were in 2012 to 2019 with very low inflation? We simply don't know. And what that means is that no one should look for any certainty in the inflation forecast or in the interest rate predictions. And that's why, much as it is very attractive for borrowers to just lock in 1 year fixed at the moment, partly because the banks are competing aggressively against each other there, one should not rule out getting a little bit of extra insurance going 2 years, or maybe have some fixed at 3 years, because of the uncertainty which exists out there. Now, having been in this business for over 3 decades, I know I could rattle on like that for 15 minutes. Still, at the end of it all, somebody's going to say, but what do you think is going to happen? Or what would you do? So my view is that in New Zealand, we have probably, as in I'm 80 to 90% sure of this, seen the peaks in the fixed mortgage rates already back in June, sort of 2.5 months ago. But I do, and things have fallen 0.2 to 4.4% since then. But I don't expect those interest rates, the fixed rates people are seeing, to fall all that much further in the next 6 to 9 months. In the second half of 2023, I think that could be interesting. I do expect lower rates out there, but the bank margins for fixed rate lending are very tight. They're well below average. There is no scope really for banks to discount those interest rates any further in the near future. On the issue of why is it when the official cash rate has gone up recently, it has not led to higher interest rates, it's because the markets have already expected that the Reserve Bank will take the cash rate, to the 3% recently, then 3.5% to 4%. It is already factored into the cost to banks of borrowing money to lend to you and I, fixed for 1, 3, 5-year periods. The Reserve Bank would have to sort of do something different, maybe come out and say, we don't think we need to go to 4% any longer. We think 3.5% is enough. Now, that would be a surprise. Interest rates fall. Or they could come out and say 4%. No, actually, we think we might have to go to 4.5 to 5%. So there's a chance of that shock as well. I don't think so. But the uncertainty is high. My view is we've seen the worst for borrowers on the interest rates, but we're not going to see any rapid fall at all for the next, 6, 9, even out towards 12 months or so. It's still going to be a bit of a slow decline further out.
So really, the message is what we talk about a lot is all you can do is think about what you can control. There's always, what your situation is, what your personal goals are, and get some really good advice. And we always say this, but it's not always, we were saying at NZHL, it's not about the rate you pay, it's the rate you pay it off and how you structure it, and that's what we're experts at. But there is one certainty at the moment, and it's a bit of uncertainty, is what we were talking about before.
The only thing I feel very certain about is that I will not be able to accurately pick when house prices bottom out, for instance. And that's a problem in that there are so many young people in particular, potential first home buyers, who think they can, or they think I can. And they're waiting until it looks like, this is when house prices are going to be at their lowest point, and that's when they're thinking about buying. They're too focused on trading houses, sort of thinking there's some sort of predictable cycle here, and they're gonna buy at the bottom, and then they can skite about it with their mates because they didn't get the opportunity to skite about buying Bitcoin when it was $1, and then it went to 60,000 US, etc. My message here on the housing side I've jumped us into here is for first home buyers in particular, stop treating housing as an investment to trade over the cycle. Remember about why people buy their first house. It's to be in it for 10, 20, 30 years to raise a family. And I've been jumping up and down in particular the past sort of 3 or 4 weeks, basically saying to first home buyers, you face a decision. Do you try to get the last 5% out of the house price cycle based on interest rates doing this, that and the other? Or do you focus on getting the house to raise a family at a time when the number of properties listed for sale is double what it was a year earlier, and vendors have now reached the point where they want to get on with their lives, they're capitulating, they're willing to cut a deal. This is the environment when the first home buyers really need to focus on what's most important. And personally for me, if it was my kids in this situation, I'd say, you don't know where the bottom is, I don't, get on with your life. And there's evidence we can talk about later that the first home buyers are starting to think that way.
Yeah, and look, you've jumped straight into the next area, which is the housing market and our first home buyers. So let's start there. It looks like, based on a few of your reports, and I canvassed a few business owners this morning from NZHL, they're back. The first home buyers are starting to just sneak back into the market. Talk us through that, Tony.
Yeah, okay. Look, for anybody seeing this video for the first time, there's something you need to be aware. I have 5 monthly surveys which can tell me exactly in real time where the residential real estate market is at. But the stuff you're seeing in the newspapers based on other data, it's out of date. Some of that stuff is 2 to 3 months old. There's one group of people and they released data saying house prices in August have just fallen away a tremendously large amount. Actually, their data is an average for the 3 months ending in August, whereas my surveys give us insight into what's happening right now. And what's happening right now is that the first home buyers are choosing to step forward. And so when I do my monthly survey of real estate agents, I've got all the results. It'll get sent out early next week. One of the questions I ask is, are you seeing more or fewer first home buyers in the market? And if we go back to a month ago, I had a net 36% of agents saying, fewer first home buyers. The month before, it was a net 54%, and it was all pretty ugly before that. This most recent result from the survey done about 1 week ago, a net 5% of agents around the country are saying we're seeing more first home buyers in the market. Not only that, I've got a net 7% of real estate agents now saying they're seeing more people show up at open homes. They're not saying we're seeing lots of people show up at open homes. They're saying the numbers attending open homes have now bottomed out and they're starting to go up. That's not happening with auctions. Numbers are still going down, but at a declining rate. And when we're talking about investors, they're still stepping back from the market. This is a unique opportunity for the first home buyers to take advantage of what is still a very strong buyer's market, but without all the investors piling in at the same time, because of course the investors have tax changes, these sort of things to worry about. So this is one reason I'm hammering this thing about the first home buyers. I don't know when prices bottom out, but I do have a view with regard to the stock of property for sale. It's 107% above a year ago at the moment, but my expectation is that as we get through 2023, the stock of listings is going to start going down again. Choice is probably at its maximum around about right now, and maybe for the next 2 to 3 months.
You have, in one of your publications recently, there's a big end game across the top. Are we hitting the end game of the price declines? And you just said it before, you can't answer that, but you think it's heading in that direction?
Okay, I don't know what month the bottom is reached, but yes, I believe we're in the end game. What I'm saying there is that the market is still going down. So if somebody's looking at a graph of house prices, they're still going down, but at a slowing rate, I believe, in the next wee while. So it's like the bell curve is approaching bottoming out, essentially. And the number of indicators I get there would be that net 5% of real estate agents saying more first home buyers are in the market. In my survey, a different one of mortgage advisors, a net 8% of those advisors said they're seeing more first home buyers coming forward looking for advice. I had a net 25% of those mortgage advisors saying they are seeing banks as more willing to lend money. The worst of the credit crunch was early this year, and things are improving as each month goes by now. Buyers are still heavily concerned about high interest rates, access to finance, and worries that they will buy and then prices will fall, fear of overpaying, FOOP. So all those readings are high, but not as high as they were a month ago, 2 months ago. So the housing market is still weak at the moment. Nobody should walk away from listening to what I'm saying here thinking that I said the market is now picking up. No, it's not. It's still weakening. But the pace of weakening is, I think, going to be slowing down. And that's what I mean by we're in the end game. We're approaching the bottom, but that doesn't say when the bottom occurs, and it certainly doesn't give any strong insight into what the other side looks like. I have great difficulty thinking prices will rise tremendously over 2023, 2024. When we're looking at net migration outflows, especially to Australia, they're probably just going to announce an increase in their net migration or gross migrant inflow of about 40,000 for the coming year in Australia. They are so hungry for us Kiwis and everybody else, with interest rates being slow to decline next year also. But my view is that over 23, well, we might get house prices rising 5% or so. After all, construction costs are going up. And we do have some supporting factors for the economy, suggesting to me we probably won't have a recession, but even if we do, I think it'll be relatively small, and the labour market is still strong. And the final comment I'll make here that I've been making for a long time now, many months, in previous downturns, people who wanted to buy a property, maybe first home buyers or even investors, would completely leave the market. Not this time. They are not visible, they're back in the shadows. They've still got their jobs. They've still, by and large, got their small businesses, etc. And they will step forward into the market once they feel a bit more security about interest rates and this sort of thing. And that's what is starting to change at the moment. People are starting to step forward. But the market is still definitely going down at the moment.
Okay, Tony, look, thank you. I think there's some, the underlying message is lots of uncertainty, but you've got to deal with what's in front of you. I noted that down from the beginning. So the usual disclaimer, Tony is an independent economist. His views are his own and not necessarily those of NZHL and vice versa, and we like it that way. And look, I will say this doesn't constitute financial advice. This is Tony and I having a chat. I'm not a financial advisor, neither's Tony, and he's an economist, by the way, a macroeconomist. So, but thanks a lot, everyone. Remember to flick us some questions. We're really appreciating those. Tony and I may do some follow-up segments with questions at another time. So, thanks a lot.
Thanks, everybody. Ta-da.